I tried to see what happens if I eliminate impermanent loss when LPing, for example, BTC to USD pair. And surprisingly, I got quite good yields. And I started investigating this more and making sure that my simulations match existing pools. The results said that it is correct. And I decided to build out yieldbasis. And basically for users works like essentially yield-bearing Bitcoin, which earns yield on top of Bitcoin value, plus I guess some noise, but nevertheless it's yield-bearing Bitcoin.
Welcome to the Edge Podcast. I'm DeFi Dad here with Nomadic. Today's show features the founder of Curve and yieldbasis, Michael Egorov. So Michael should be no stranger to our audience, having been the inventor of the Curve protocol and tokenomics. He has been making waves in the space for years, since DeFi Summer. We are excited to talk about his newly launched protocol yieldbasis, which allows us to earn amplified Bitcoin yields using Bitcoin LPs with hedged impermanent loss under the hood.
I think the headline here is currently they're getting yields of between 21 and 35% on Bitcoin, which is nuts. So we dive into how this is possible. What are the risks? How does this scale? Is there points of diminishing returns? How big could something like this get? We talk about all of this.
And to be clear, they're starting with Bitcoin first. So there are 3 pools. They have a total of 150 million TVL already in the protocol, with the new yieldbasis token having just launched. But they have aspirations of offering these types of vaults for other volatile, very liquid assets, maybe something like ETH or even tokenized gold.
We also talk about the synergies between Curve, Michael's first protocol, and yieldbasis, this new one, and some of the pushback that some of the community had with Michael launching a new token with yieldbasis. So we get his answer on that as well.
So before we get started, just a quick reminder, you can subscribe at the-edge.xyz. That's the best place to subscribe to the Edge newsletter and to get real-time notifications for the Edge podcast anytime we release a new episode. You can also check out our link tree at edge_pod. That's the best place to subscribe to the Edge podcast on Spotify, Apple Podcasts, or YouTube. And then one last shout out to all of our sponsors that make the Edge podcast and the Edge newsletter possible. Sponsors like TOROS Finance and REDSTONE. Otherwise, we hope you enjoy the episode. Grow wealth exponentially. With TOROS leveraged tokens, when the market moves in your favor, your gains become parabolic. They're built to ride trends, auto-compounding profits. With TOROS, it's simple. Pick a vault, deposit, and your exposure is multiplied, maintained, and protected automatically against liquidations. TOROS reduces risk and keeps you in the market ready for the rebound. When markets dip, the vaults auto-adjust, softening losses and preserving your position. Just pick a token to multiply your returns. TOROS Finance, exponential gains with leveraged tokens. To learn more, go to toros.finance. REDSTONE is building the Oracle backbone to unlock real-world finance on-chain and next-gen DeFi. With modular gas-efficient feeds across over 110 chains, trusted by 170 clients, supporting over 1,300 assets, from value-accruing stablecoins, liquid staking and restaking tokens, to treasuries, private credit, and commodity tokens, REDSTONE delivers accurate real-time data where it matters most. The biggest platforms and protocols in DeFi today choose REDSTONE oracles, such as Athena, Securitize, BlackRock Biddle, Pendle, Spark, and Maple Finance. If you're building the future of finance on-chain, you need REDSTONE's leading modular blockchain oracle layer. To learn more, go to redstone.finance, and thanks to REDSTONE for supporting us here at the Edge Podcast and Edge newsletter. Banks use your money to line the pockets of shareholders. Meanwhile, SOLSTICE uses the same yield strategies to line your pockets. Introducing Yield Vault, Solana's best yield. a live delta neutral strategy with positive returns month over month for 3 years. Built for internet capital markets and powered by the stablecoin USX. To learn more, go to solstice.finance. Neutral is the next generation of crypto-native yield. Their synthetic dollar NUSD taps into OTC arbitrage, funding rate inefficiencies, and delta-neutral strategies to deliver premium, stable returns without taking market direction risk. Neutral is currently live in private beta and will be opening for public deposits soon. Learn more at neutral.fi. All right, let's introduce Michael from Curve and YieldBasis. Michael, welcome to the Edge podcast. How are you doing?
Good. Nice to see you.
Good to see you too. It feels kind of silly to ask you to give your background, but in case someone is newer to DeFi, tell us about all the work you've done with Curve over the years before we get into YieldBasis.
Sure thing. So in the beginning of 2020, I started Curve, and I started that out of a very simple necessity. I was actually using MakerDAO for borrowing against ETH because I thought ETH is so valuable that I didn't want to sell it. I borrowed DAI against ETH since 2018. And when doing that, I obviously needed to, to withdraw my DAI to bank account as dollars. And how do you do that? So I had a Coinbase account at the time and swapped DAI to USDC and withdrew it as USD. But I noticed that all the exchanges swap stablecoins very, very badly, whether centralized or decentralized. And, I had some other ideas, actually, about what we now call liquid staking. But I thought, well, maybe the algorithm I was thinking about is probably suitable to solve my need with stablecoins. So I launched Curve, primarily focused on stablecoins. And, here we go. It became probably the most important exchange in the stablecoin world. So that's background with Curve.
So, Michael, as somebody that's seen DeFi grow from its, I'd say, like extremely awkward beginnings, are you surprised to wake up in the year 2025 and see where things are at right now? What's like your just general impression of the DeFi landscape these days?
Well, I'm probably not surprised where DeFi is right now. I'm probably surprised that it's not further used than, like even more used than it is today. But there are good reasons for that. As you mentioned, there were some awkward starts. And back in 2020, 21, and 22, there were many. It was a time of experiments. Like, people tried absolutely everything, and one of the absolutely everything things was Terra. And when it collapsed, its ripples were kind of preventing people, keeping people scared of DeFi for some time. If not that, DeFi would have been much bigger today, I think.
So Curve remains a foundational DeFi money Lego. I think that Curve also was aggressive and early to deploying on other EVM chains and new L2s. Given all that success, I'm wondering, where did the inspiration come from to start working on YieldBasis?
I think it all started probably when I was thinking about lending with unliquidation or like deliquidation, which is implemented in Curve stablecoin now. And I just thought of some algorithm how to not just liquidate things, but also unliquidate, so that if you dip and go back up, you are back with your collateral. But actually, if you at that time when I figured this algorithm, I realized I could turn it into a different thing and essentially use it to eliminate impermanent loss. I didn't do it at that time, and I didn't yet. I wasn't yet able to run simulations of trading cryptocurrencies in AMMs that well. Now I figured out how to do it and how to have these simulations having exceptionally good predictive power. And when I did that, I tried to see what happens if I eliminate impermanent loss when LPing, for example, BTC to USD pair. And surprisingly, I got quite good yields. And I started investigating this more and making sure that my simulations match existing pools so that I'm not lying to myself. And the results said that it is correct. And I decided to build out yieldbasis. And basically for users works like essentially yield-bearing Bitcoin, which earns yield on top of Bitcoin value, plus I guess some noise, but nevertheless it's yield-bearing Bitcoin. And right now we have almost a month of yieldbasis running, and maybe several weeks of yieldbasis running with essentially $150 million worth of Bitcoins deposited. And that is actually the right number to already see the system working as simulated. So I studied how it worked with this real data now, and I'm very excited to see that simulations were actually correct. And actually, it does work as yield-bearing Bitcoin when you eliminate impermanent loss. So, and that's very good.
I want to dive into a bit more of these mechanics underpinning yieldbasis, but first I just want to take a quick step back and look at why it's been so hard for people to productize Bitcoin yield. I mean, there's some out there in the market, but I think yieldbasis looks to be a major kind of step function in the advancement of generating yield on Bitcoin. So yeah, why has it been difficult?
Well, I think there are two things here: yield on Bitcoin and automated market making for cryptos. So for yield on Bitcoin, it's actually quite simple. How do you earn yield on Bitcoin? Well, I think what people tried, you can lend Bitcoin out. You can lend Bitcoin out and somebody will borrow it to, I don't know, short it or something. And on Aave, you can earn a whopping 0.2% APR on it, right? So not very interesting. There are things like, I don't know, like restaking, but with Bitcoin. So like you make some chains which inherit from Bitcoin's security, presumably. And there are some other projects, who God knows which will pay you some yield to to have your to have their network secured. To start with, restaking is probably more native to Ethereum, and also I'm not entirely sure that restaking actually has real users on the demand side yet. On the supply side, yes, a lot. Everyone wants yield, but the ones who actually keep the yield, even in Ethereum land, didn't prove itself yet. So in Bitcoin land, it's actually even trickier. So at the moment, these projects are providing yield out of token printer, which is not necessarily a sustainable story yet. So that's, I think, the state of yield on Bitcoin. Well, there is one other thing you can do on Bitcoin. You can borrow against stablecoins against Bitcoin. You can borrow USDC, right? And supply it into something which pays bigger yield, but probably more risky. You can earn 15% APR or something if you put this USDC on Curve into some stablecoin pool, USDF to something else. I think 15% you can get there. And you essentially pay less for borrowing on Avi than you earn somewhere else, and that is borrowed against Bitcoin, and here we go, you have a yield on Bitcoin. But in this case, you have risks, and the risk is that your Bitcoin collateral could go down, of course, but also there is a risk, like what if the project or stablecoin you put these stables to earn funds, what if something wrong happens to them? And that is a risk, and the net yield is not necessarily huge for that risk. So that's kind of a problem with this approach, but probably that's the highest yield you could get on Bitcoin so far, right? And there is, I think, one more thing I wanted to say is that we have a problem of earning yield on Bitcoin. There is a problem of crypto liquidity provisioning in general. And this problem is exactly what people call impermanent loss. I actually used to say that impermanent loss is not a problem because it's not a loss, right? But for some reason, people don't buy it, because really, clearly, if you put one amount of money and if you get out with a smaller amount of money, if the price went in either direction, and this reduction depends on the eventual price, that's not good, right? So, and that was really one of the things which prevented people from providing liquidity. And it didn't become better with Uniswap 3. So Uniswap 3 is actually a little bit like limit orders, but they are like two-way limit orders. Like when you buy from the sell limit order, it turns itself into buy limit order, right? So that's essentially almost how Uniswap works. And if you have something which reminds you of limit orders, you probably would better have market makers. And indeed, Uniswap 3 and 4 works better with market makers. And it's not really democratized liquidity provisioning. In fact, it's actually very hard for someone from general public to make money on Uniswap 3 and 4. Actually harder than it was in Uniswap 2. Well, you can make a full range position, of course, but but anyway, sounds like impermanent loss was not solved so far, and it was still unclear how to make money from market making for like a passive liquidity provider. And this is why we don't have too much liquidity in crypto pairs. Like in stable pairs, it's fine. Stable pairs are solid. When Ethereum USD supposedly crashes on Binance, on chain, everything is fine. And I can say that it means that in reality, everything is fine and something is not fine with centralized exchanges. But in DeFi, it's good. So liquidity, stable liquidity lives in DeFi. I cannot say that for crypto liquidity. And in principle, yieldbasis solves that, at least for the major cryptocurrencies, starting with Bitcoin.
Yeah, so to summarize, there are multiple opportunities and challenges here. One is that Bitcoin is still the largest crypto asset in the world, and I believe something like less than 1% of it is being used for any sort of DeFi-related activity. So most of it just sits idle. Meanwhile, that audience wants more of Bitcoin. They want to earn more of it. But then the issue is that one of the best opportunities, market making or holding a liquidity provision on an AMM-like curve, the problem with that is that there's impermanent loss. And so this creates this awesome opportunity for what you're building with yield basis. We'll get to the actual yields here in a bit, but I just want to, tease the audience with the fact that I believe you forecasted yields as conservatively as 10% to, upwards of 20+%. So to go from an average yield of, let's say, less than 1%, I mean, if you lend WBTC on Aave, you're earning something like 0.01%. Just to be able to earn 1% or more is fantastic, let alone something like 10 to 20%. So before we get to those numbers, can you start to walk us through how does yield basis work? What happens under the hood? How are we earning that yield?
Right. Well, first of all, we have, since 2021, there is Curve Crypto Swap. And some people think that Curve Crypto Swap is about a special shape of invariant which makes this AMM function. It's not exactly that. The essence of Curve Crypto Swap is automatically managing concentrated liquidity. Concentrated liquidity can be described by any bonding curve, but the actual trick is how do you manage concentrated liquidity? So Curve Crypto Swap does automatically manage concentrated liquidity, and that's since 2021. But there is a problem. When it manages that, you have impermanent loss exactly like in Uniswap 2. So that property in Curve Crypto Swap is the same as in Uniswap 2. What is different is that you have concentrated liquidity and it's automatically managed, and that's why you earn actually more than in Uniswap 2. But you still have the same impermanent loss. So now let's think of what's the value of your liquidity in Uniswap 2. I don't know if you probably provided liquidity in Uniswap 2, so you probably know. But if you provide liquidity, for example, between WBTC and USDC in Uniswap 2, right? What happens? The price of your LP will be proportional to square root of Bitcoin price. So, in other words, if you put 50K worth of BTC and 50K worth of USD, you have 100K liquidity. If Bitcoin goes up by a factor of 4, your 100K turns into 200K because square root of 4 is 2. And if you didn't put money in Uniswap 2, and if you just put them aside, then your 50K of Bitcoins would turn into 200K, and you have 50K of USD, so you would have had 250K, not 200K. So that's why that's what people call impermanent loss, is that the growth here would be actually smaller inside AMM than outside, and the same actually applies to the value dropping. So you still have less in AMM than in doing nothing. But AMM earns fees on top of that. But anyway, so important is square root, right? So Uniswap 2, Curve Crypto Swap, everything has this square root dependency. And that is what we don't like. We want to invert square root. So how do we invert square root? And, inverting square root is calculating a square of it, like power of 2. So how do you make power of 2 of something? And here I had this idea. So maybe if we have compounding leverage, right? So leverage which has factor of 2, but if price of your collateral goes up, you borrow a little bit more to keep loan to value ratio the same, 50%. Maybe then you have the resultant position being square of your collateral price, and that's actually exactly how it works. So we put liquidity between Bitcoin and USD as collateral, and leveraged it by a factor of 2, and having this leveraging compounding. And if you do, or like you you put more into leverage if the price goes up, but you deleverage as the price goes down to keep LTV 50%. And if you do that, it appears that impermanent loss, this square root dependency is exactly eliminated, and the price of your position will be proportional to Bitcoin price plus the earned fees minus losses. And that appears to work.
This episode is brought to you by MANTLE, pioneering a revolutionary new category called blockchain for banking by bridging TradFi and Web3 into one unified stack. With on-chain transactions, TradFi rail compatibility, and integrated DeFi features, MANTLE is reshaping how financial services work. Their flagship app UR lets users hold fiat and crypto all in one Swiss-backed account, making real-world finance usable on-chain. To learn more, go to ur.app and follow mantle_official on Twitter. As a DeFi investor, I turn to Maple for permissionless institutional quality yield in a single liquid asset backed by over-collateralized loans. Maple's SYRUPUSDC and SYRUPUSDT are now supported as collateral for enhanced yields on major DeFi liquidity hubs such as Pendle, Fluid, Camino, Jupiter, Morpho, and soon Aave. To learn more about Maple, go to maple.finance.
So, Michael, you've been live for about a month, I think you said. What sort of yields are you seeing so far? Are you happy with the results? Is it in line with expectations?
I'm actually very happy with the results. You mentioned that the yields I was thinking of looking at simulations were from around 10 to around 20%. And it looks like fundamentally, after looking at, I just needed enough data in live to know what it is, because everything is actually pretty noisy and you need some time to observe. And it looks like we are looking more at 20%. Before, of course, any tokens or anything, a fundamental yield.
And that's factoring, any sort of lag or slight deviation in underlying Bitcoin as well. That's taking into account sort of all those factors.
Yeah. What do you mean deviations of underlying Bitcoin?
Well, I guess I mean like with all this sort of active hedging. Say you put in one Bitcoin and you take out one Bitcoin. None of that, none of your underlying is impacted if everything works as intended, right?
Yeah. You have, that's the net result after you subtract all the expenses. That's happening inside. But what I'm saying is that after you sum up all the yield and subtract all the like expenses and losses, you have this kind of similarly 20% yield. I cannot promise it will stay 20%. It's probably because market become a little bit volatile, and that is very good.
Michael, what synergies are there between Curve USD's growth and yieldbasis? They clearly work together here.
Oh, that's a great question. Because when yieldbasis works, Curve crypto pools go slightly out of balance. Ideal balance is 50-50, but they can go 45-55 or 48-52, or even when during October 10th crash, it went as big of a misbalance as 40-60. And we need to be able to withstand the misbalance of Curve crypto pools like 40-60, right? So when everything is ideally balanced, the loan we took is of the same size as amount of Curve USD in Curve crypto swap. So they balance out each other, the loan and the Curve USD amount in the pool. So the pool is a supply sink for Curve USD, and that's zero effect on Curve USD peg. But that's the first order effect. There is a second order effect. When the pool goes out of balance, then indeed there is either positive or negative price pressure on Curve USD. and the system has to be able to withstand this price pressure. So I estimated how much liquidity CurveUSD should have, and I've published that in blog post, but it sounds like whatever stablecoin, CurveUSD, right, yieldbasis chooses, yieldbasis has to ensure that there is enough liquidity in that stablecoin. Inside yieldbasis, there is a special chunk for it. It's like Curve licensing fee or whatever, but it is, the best use for it is to incentivize votes for CurveUSD pools, CurveUSD stable pools, because they work both as a supply sink for CurveUSD and as a liquidity when things are volatile. So if that happens, like veYB tokens spent on buying votes for CurveUSD pools, then CurveUSD flows in these pools, right? And then what? They work as a supply sink. CurveUSD borrow rate goes down, right? And people start borrowing more CurveUSD. So CurveUSD system grows. At the same time, a lot of trading volume which is happening in yieldbasis goes also through the same pools, so they earn fees. Also, if volatility is high, then CurveUSD peg tries to be shaken, and peg keeper mechanism tries to stabilize CurveUSD. And when it does so, it actually earns money for Curve it as well. So it sounds like there are several revenue streams appearing for Curve when yieldbasis is working, and that is all ensured by yieldbasis streaming some of veYB tokens to actually incentivize CurveUSD pools to grow. So sounds like yieldbasis has no choice but to grow CurveUSD, and that is good.
Just to reiterate, I think you've made clear that there is a choice when we enter one of the 3 different Bitcoin LPs on yieldbasis. We can either stake the LP and ultimately earn the veYB token, or we can earn the actual Bitcoin denominated trading fees. Anything else to share there in terms of that incentive design?
Yeah, so that's actually an interesting design, because I think it's very friendly to integrations. One can integrate essentially yield-bearing Bitcoin without caring about incentives, or one can earn incentives, but then of course foregoing the fee yield, right? So either one or the other. If let's say if everyone stakes this liquidity, if everyone tries to earn tokens, not the real yield, then of course veYB inflation has to be at its maximum, which is fine. But then nobody wants to earn real yield, so real yield can all go to admin fees to the system, which is probably great. But you can imagine the opposite. Imagine that everyone wants to earn real yield and no one wants to earn token. That's possible. But then, of course, you still have some admin fee, but it's not very high. But what's more important, if nobody wants to earn tokens, then why should we have token inflation? So token inflation is dynamic, and depending on how many people want to stake, it can range between 0 and maximum. If nobody wants tokens, then inflation is 0 and can be saved for further times, and that's happening automatically.
Michael, I saw some people on X kind of taking some shots at why another token. I think kind of listening to all of this, I see the synergies between the 2 protocols, and probably starting from a clean slate made a lot of sense. But yeah, curious kind of your take and how you've been addressing that.
There are quite many reasons for that. I think one of the reasons is bootstrapping a new system with a new token is actually probably easier. So when you have an old token, you have old, well-established governance procedures, and you may need to move a little bit faster in the beginning of something very, very new. That's one thing. Also, I did want to refactor how you do VE tokenomics, and I think I quite succeeded in that. For example, one of the things, I cancelled Thursdays, right? So in Curve, if you vote for some pool, your vote actually becomes real only on Thursday, right? So it's all everyone waits for Thursdays. In yieldbasis, you actually don't have to do it. Also, token inflation is not like changing every year or every 4 years or whatever. It's just exponentially falling, and it's also dynamic, depends on how much people stake. So this is also interesting. So I just really wanted to do something new in token economic design as well, and I think that's good.
One more question just on that. So correct me if I'm wrong, but was Curve the first protocol to introduce V tokenomics?
Yes, I invented that.
Okay, so with yieldbasis, you've already kind of mentioned a few iterations and tweaks. You know, as somebody that's seen V tokenomics from the beginning, and not only seen it, but literally invented it. What other tweaks or modifications or novel properties are you introducing for the V tokenomics on YB?
Yeah. So I think right now, when we have Ethereum accounts working essentially as smart wallets, at least theoretically, right, with Spectra upgrade, I think it doesn't make sense to forbid smart contracts to lock. Right, so I did make it so that you can transfer your positions as NFTs, but there are a few tweaks to that. You can only do that if you max lock to 4 years, and if you transfer this locked position to another position, they actually fuse, so you can really split them after that. But that is by design. But I think it's important for people to be able to transfer their positions to multi-sigs, for example, stuff like that. So that's I think something where it needed some change, and I did refactor how gauge voting works, and also I think that the mechanism of boosting the token rewards, which I introduced in Curve, is not necessarily always great, right? So it helped to essentially bootstrap monopolies like Convex, StakeDAO, Yearn on Curve. And it's not necessarily a bad thing. They are actually great. They are helping with business development, Curve, right? But also it's a little bit less decentralized, and I think the root of that is in this boost mechanism. So I am not, and boost mechanism is also introducing a complication in the design, so I removed it here. There is no boosting of token rewards with VE voting power.
One thing we keep referring to is this VEYB. Remind us, why are users locking up YB tokens for up to 4 years? What does the voting power allow them to do? Do they have a claim on fees? Like, what are all of the benefits of VYB?
Yeah, so you do have voting power in YB governance when you lock YB tokens, and the voting power is proportional to the token amount you lock and to the time you lock for. So if you lock YBs for 4 years, you get 4 times larger voting power than someone locking YB for 1 year. The same applies to the earning power. When the system fees will be distributed, someone locking YB for 4 years will be earning 4 times as much as someone locking the same amount for 1 year. So there is a big incentive to lock for a longer time. So that's, of course, one. Well, it's actually two things, because we have both voting power and earning power. And voting power appears to be not worthless. That's happening when you introduce gauge voting. So when you have when every user, without any proposal, can just vote towards one or other pool, and it gets more inflation, that appears to be valuable. One thing I noticed, well, when the thing started, I voted for all pools equally. So they all should be getting equal YB inflation. I noticed that inflation now to these pools is not equal to each other. It's uneven. And thought, why? Is there a bug? So we started checking. It appears to be that people started getting YB tokens, I don't know from where, free market or whatever, locking them and voting for the pools they have deposits in. So if they deposited to TBTC, it seems like, they vote for TBTC pool, right? So they essentially vote for the pools where they have their funds to increase their earnings. And that's their use of YB even before selling their votes. So they don't sell their votes, they just use them directly to increase their revenues. That's pretty fascinating.
Yeah, and one thing that's emerged in the past, if you've been, part of this crypto lore for as long as we have, is just this idea of the wars. We like to use the term wars. But one thing I see when I'm just like looking at your UI right now, you've got CBBTC, TBTC, and WBTC. A thing that could happen, kind of along the same line of thinking that you're talking about, is, hey, what if Coinbase really wanted to get a lot of BTC into their CBBTC vault? They could start putting a lot of the inflation towards that vault and hopefully attracting even more TVL. And then the upside benefit for Coinbase is, okay, we get a lot more CBBTC exposure out there in DeFi and in the hands of users. So it can create one of these sort of win-win loops, is like another, I think, powerful kind of hidden force of these tokenomics.
River is building a chain abstraction stablecoin system that connects assets, liquidity, and yield across multiple chains. Season 3 is live. Earn River points by using SAT-USD in DeFi such as Pendle, PancakeSwap, and Uniswap. Stake River points to accumulate more or convert points to River tokens whenever you like. To learn more, go to river.inc. Hey folks, I want to tell you about our sponsor GEARBOX, the protocol that reimagines on-chain lending. With GEARBOX, you can access 10x credit across DeFi or lend for passive yields with single asset deposits and no impermanent loss. Users can access leverage to margin trade, stake, farm, and more. To learn more about GEARBOX, go to gearbox.fi. Puffer Institutional delivers secure, high-yield Ethereum staking built for institutions. With battle-tested security, granular access controls, and the ability to boost APY by securing multiple AVSs, Puffer gives institutions full control and optimized returns. Puffer is also behind the Unify-based rollup, aiming to transform Ethereum's future in a world where all L2s are working together. To learn more, go to institutional.puffer.fi.
So all these Bitcoin DATs, these digital asset treasury companies, I feel like there's not a ton of differentiation between them at this point. And I don't know if this is something that you've thought of, Michael, but something that I see as would be a massive differentiator is like, hey, can we get our Bitcoin yield? So are these any sort of discussions? Like, have any of these early DATs that want to differentiate been like, this could be interesting?
I didn't talk to the DATs directly just yet, but I think it definitely will be something they will look at. At least if they are allowed to put funds in DeFi, but I think they will have to, like, if otherwise they don't differentiate.
So something you alluded to earlier when we were talking about early DeFi is the Terra collapse, and I think everybody's got scars from that or some form of PTSD. So, whenever we see a 20% yield on something, immediate gut reaction is too good to be true or something along those lines. So I want to dive into the risks that you see with yield basis or worries that you have. Where does it fall apart or hopefully not unwind, but where does it deviate?
Actually, first of all, the yield APR is not always the measure of risk. It's the measure of perceived risk, of course. But also in DeFi summer, where we were used to yields like 1,000% APR, and it was actually fairly safe. Right? Where was the catch? And the catch was that this yield was going down as the systems scaled up, right? Or as the hype went away. And well, here the yield is where is the yield coming from? The yield is coming from asset volatility, right? So the more the asset is shaking, the better the yield is. Of course, if you scale the system up, so let's say we scale the system with Bitcoin and it becomes really big, like, I don't know, 10 billions, 20 billions, 50 billions, then liquidity and yield basis will start affecting Bitcoin price. Like, affecting Bitcoin price, I mean, probably it will stabilize it. And the yields will start going down when that happens. So that is where the saturation happens, when the whole market, Bitcoin trading, starts being, if a whole market yield basis starts dampening the volatility. So that's kind of a risk, which not like a risk, it's like how the saturation curve would look like. But what are the risks? Because there are some, of course. And of course, there are technical risks and whatever. Right? So that's fine. But what is the fundamental risk? Fundamental economic risk. Fundamental economic risks probably come from the volatility itself as well. So if Bitcoin price, I don't know, drops or moves very, very quickly, like instantly, and by a lot, like by factor of 2 or 3 or 4, and doesn't come back, then it's actually very bad. But I didn't see Bitcoin doing that. But I did see altcoins doing that. So I think I wouldn't dare to put altcoins, excluding Ethereum. Ethereum is good. But I wouldn't dare to put, like, I don't know, DeFi tokens, for example, in yield basis. I don't think that would be safe, right? So the major cryptos are fine. They are not doing that crazy stuff. But altcoins are probably not necessarily fine. So that's, but yeah, that's definitely a risk. And of course, there is another risk of like, it's the system feeds from volatility. What happens if, I don't know, if the White House gets tired of putting tariffs on and off, right? And then volatility stops being so volatile, then we probably will have smaller yields, right? So anyway, need the world situation to be as volatile as possible. That's the bet here.
Speaking of volatility, we are recording this a few weeks after the flash crash that happened on Binance on October 10th. You had a write-up about the stress test it was for yield basis. What were your takeaways from that? How did yield basis perform?
One thing I've noticed, in yield basis, every pool has essentially 2 AMMs. One is curve AMM, and another is releverage yield basis AMM. Spread between 2 AMMs can vary, but it cannot be smaller than 0, right? Negative spreads are bad. Usually negative spreads mean that arbitrage is not happening. And during that flash crash, I did see spreads being negative for 20 minutes. That happened because Ethereum gas went up to be very, very large. But the pools were just, 10, they were small, right? And because of that, because these pools were small, arbitrage in gas costing like 1,000 GWA was not profitable. And spreads were negative, but also it's a sign that you have a loss happening in the system. I reanalyzed it later. And surprisingly, the system itself was not profitable, right? So there were a few other reasons why this profit didn't get to users. It's basically has to do something with how it started and few parameters of curve crypto pools, like new version of curve crypto pools, which I didn't think of. But by itself, fundamentally, the system actually performed really well, surprisingly well, in the crash. So this crash is actually okay. But the system works better if you have bigger TVL. If you have small TVL, then arbitrage can be not efficient in such time because gas is high, and that's risky. So low TVL is risky, apparently. At least on Ethereum.
So one thing with this setup, I'm curious if there's any point of, I guess, sort of diminishing returns here. How big could these BTC vaults get? Are we talking, hey, maybe $1 billion? Is it 5 billion? Is it tens of billions? Like, where's the point, that line in the sand where you're like, actually, the yield might not be as good. The system can't function as good.
Absolutely. This is a great question. So I did try to estimate that. Fundamentally, system starts working not as well when the operation of the system itself affects Bitcoin volatility. So Bitcoin starting being less volatile than it is. Well, I mean, if people will start leveraging more Bitcoin, it will become more volatile. But, assuming that things are as they are today, how to estimate that? So I compared a liquidity around the current price in hypothetical yield basis pools and in all exchanges in the world, right? So if this liquidity in yield basis pools kind of matches liquidity in all exchanges in the world, then you probably will have yield basis started dampening the Bitcoin volatility, and you will start getting returns diminishing. So which TVL does it correspond to? So some estimates show that it probably should happen around 50 billion TVL. So that's, I think, where this point is. But I'm not entirely sure because I haven't seen it for real. So when we get there, we will figure out, is it the point of diminishing returns or not?
Given the yield that you are forecasting for these Bitcoin LPs, I'm wondering, are you thinking of any other assets to create for yield basis? Like one would be ETH, but maybe a more obvious one given the viral demand right now for the asset is gold. So we have some tokenized gold on chain. Any thoughts on that?
I think first we need to try Ethereum because there is definitely a clear demand over there. And I know it for a fact it is possible for Ethereum because I did some early simulations. It looked decent. I think the only point where Ethereum didn't work well in simulations, however I tried, is FTX collapse. Like when FTX collapsed, I couldn't get rid of the loss, right? For Bitcoin, there was no loss, but for Ethereum, there was some, several % loss, and I just couldn't get rid of it over there. So Ethereum at that time really crashed quickly and seriously. But otherwise, in other times, Ethereum works great, and it actually has returns no worse than Bitcoin for sure. So it's good. For gold, I think it's also a very good thought. I didn't yet simulate a yield basis with gold. I think that returns with gold will be significantly smaller than with Bitcoin or Ethereum, but they might be non-zero. So I will check that. Maybe it's a good one.
Michael, I actually remember when you shared yield basis with us, I don't know how long ago it was. Maybe it was like 5 months ago or something like that. But I think we talked about gold, and it was funny because at the time we talked about how it wasn't volatile enough. But the crazy thing that's happened, well, like what's happened since that conversation, right? It's like doubled in price, and like then it's dropped a bunch recently. It's like it's showing some crazy volatility again. So
gold just got upgraded for yield basis, right?
Before we wrap up, we need to recap the ongoing campaign to bootstrap liquidity. I think at the end of September, there was a campaign launched before the yield basis token launched. You had 3 different pools: CBBTC, WBTC, and TBTC. All 3 filled up to 50 million, 150 million TVL in total. So when will caps raise? What's next?
Right, yes. So, you're right that the caps are really full right now. And I was actually researching when it is safe to raise the caps, because this question is really up to not only testing the mechanics in prod, but also up to CurveUSD stablecoin stability. So to raise further, we need more CurveUSD liquidity. For that, there is a special allocation of YB tokens proportional to YB token inflation, which is in control of CurveDAO, and it has to be used for incentivizing CurveUSD liquidity to make sure that CurveUSD will sustain all sorts of swings caused by yield basis pools becoming big. So there are 2 votes for that in Curve right now. They're already running. People are already voting. When the votes will conclude, then we will have incentives starting flowing to CurveUSD stablecoin pools, and in principle, we would be ready for raising the cap further. The next step, I think, should be 500 millions in Bitcoin or in yield basis, right? So with these votes enacted, there will be enough CurveUSD stablecoin liquidity. But if we want to go further, of course, we need to have Curve pools becoming even bigger. And that probably needs fee distribution to be happening internally for veYB. Because without that, you don't have the economic system being in a closed loop, and you just will not have the value of this, the value stream from YB tokens being big enough. So we need to close the value loop. And that's the next step after, or maybe simultaneously with raising the caps to 500 millions. And when this value loop is closed, sometime after, we can raise caps above 500 millions. And I hope to reach the scale where, the scale of the point of diminishing returns, right? So I want to scale up to that, which is probably several tens of billions. But that should happen, cannot happen instantly. So to connect all the revenue streams in the system so that it is working as a whole.
Michael, do you foresee the YB vaults, these different Bitcoin vaults, do you foresee any of those being listed as collateral for borrowing on other platforms?
Oh, absolutely. That's an excellent idea. And actually, this is this. YB inherently leverages pools, and pools have spread. and spread is not small. It is as big as 2%. But it's, of course, okay, the spread is 2%, and you have half in Bitcoin, half in USD. So the value of the collateral fluctuates by 1% fairly easily. But we leverage it by a factor of 2. So here the position value fluctuates by 2% all the time. And some users may not like it. And this is, you cannot do anything to it. It's like, it's inherent to the system. You have growth, of course, but you have noise on top of growth, and not all users like noise. So what can help here? If YB BTCs are listed as collaterals, then maybe some people can lend BTC to be borrowed against that. And you will have people who absorb these fluctuations and loop, borrowing WBTC against YB WBTC. So they earn multiplied yield, and those people who lend out WBTC earn smaller yield but stable. So lending can stabilize these, eliminate these fluctuations for those who don't like it. And of course, it's also good to be in PENDLE, right? So in PENDLE, you can have like maturity dates and whatever. So it's kind of a different sorts of mechanics. I like stabilizing yields with lending protocols more than what you can do with PENDLE. But PENDLE definitely is definitely popular. So it's another good mechanism. So I think these are excellent DeFi tools, and they will be utilized.
Do we know if a PENDLE pool will be going live soon? Like, have you confirmed any launch date, or if PENDLE will list a pool?
Well, first I think we need to get the cap a little bit up, because right now everything is full. So like it's kind of doesn't make sense to do something there. But when caps are big enough, then it makes sense.
Yeah, once that goes on PENDLE, I would imagine it will be able to drive some really impressive fixed yields. And obviously there's the speculative nature with YTs, and PENDLE marries those two types of users and really creates this incredible opportunity for folks who just want a fixed yield, a predictable yield, versus those who are willing to trade the yield or speculate on that yield.
Yeah, that's absolutely. I think over here we could superpower all the DeFi once again.
I think this is a great place for us to wrap up, guys. So first, I want to remind our listeners they can learn more about yieldbasis by going to yieldbasis.com. Follow yieldbasis on X or Twitter, whatever it is. And then follow Michael. His account is NewMitchWill. We'll put that all into the show notes so you can easily find that. Michael, thank you so much for your time. Always a pleasure to get to talk with you. Very excited for those caps to get raised. I need to deposit myself into those once that becomes available. But any final word for us before we go?
Yeah, I guess we covered everything. It was a great pleasure talking to you, and let's make DeFi great again.
Thanks everyone for tuning in. To stay up to date with future episodes, plus get expert tips, strategies, and exclusive content, subscribe to our free newsletter at the-edge.xyz.